The stock market has been crashing. On Monday, we saw the Dow Jones plummet by over 2%, and the Nasdaq and the S&P both lost over 2.2% in value. Then yesterday on Wednesday, we saw the Dow sink another 900 points, and we are entering into stock market correction territory. So is a major stock market crash coming soon? The election's coming up within a week, and this is a very volatile time for the market. So in this video, I want to discuss what I'm doing for my personal portfolio, what I expect the stock market's going to do, and what stocks I'm watching and I plan on buy during this recent dip. So the Dow Jones has been plummeting. You can see here from its most recent high over the past month of over 28,800 points, you can see it has crashed by over 8%. If we take a look at the S&P, from their most recent high this month as well, the stock is down over 7.4%. So we're entering into that stock market correction territory, which is when an index or an individual stock sees a 10% decline from its high. So once we hit that 10% threshold, we are by definition in a stock market correction. So of course, everyone has their own perspective on the market, and some believe we really only enter correction territory once we hit that 15 to 20% drop. But by definition, a 10% decline in the market means we have entered into a correction. And as we approach this mark, it may be a nice time to jump in and add to your existing positions, or find a nice sale, a nice deal in the market, and start a new position for your portfolio. So as you know, everyone, I am the Gen Z investor. We talk about the stock market every single day, and in this video, we're going to focus on this most recent decline, discuss some reasons why we're seeing the red in the market, and overall go over what I plan on doing with my personal financial freedom portfolio that currently sits around $62,000 and has seen a massive decline as of late and has followed the overall market down into the red. So please hit that like button and subscribe. I want to continue on with this stock market crash, and we will have to see if this crash will live up to the hype that we're expecting, and if it will follow the crash we saw in March, and if we will see a decline of 30% from the most recent highs. So there's a couple main reasons that different analysts are contributing to the reasons behind this market crash. One of them is the fact that we found out for sure we will not be getting a stimulus deal before the election. So House Speaker announced that there's going to be no relief deal before the election, and as you know, these debates have been going back and forth for weeks and months, and there's a ton of different videos on YouTube for some of the best content creators that discuss in detail every single aspect of the debate and then of the negotiations. So I'm not going to focus too heavy on the details, but the major headline and the fact that we are not going to get a stimulus deal before the US election is one of the reasons why we are seeing this pullback. Another one of the major reasons is because of the pandemic, worries of another shutdown of the economy, worries at the fact that the pandemic is actually statistically getting worse as time goes on, and the fact that we may see growth in this global issue that will cause a reduction in the economy, force businesses to shut down once again, and of course, any potential lockdowns hurt not only businesses, but overall the economy as a whole. And this actual pandemic is not only going to impact the United States, but this is a global issue that is impacting not only US and Canada, but of course, Europe, Asia, and many continents around the world. So for my personal portfolio, it has been hit very hard as well. We are down over $2,000 yesterday, with a 3.4% decline in one single trading day. So as this portfolio continues to grow, these declines in single day tradings are getting bigger and bigger. In one single day, my portfolio lost over $2,000 of value. So that is a lot. That's a significant amount of money and a lot of value lost within one single day, and the portfolio dropped by 3.4%. So what I plan on doing during this dip is I don't plan on selling anything. I hold 21 different companies in my portfolio. I hold solid blue chip dividend payers. I have a variety of low yield, high growth stocks compared to some higher yield, slower growth companies as well. I have a variety in different sectors of the market, and I believe I'm nicely diversified into strong brands that will weather any economic storm. They've proven to hold up very nicely so far during this pandemic, and I believe these companies will continue to weather the storm moving forward. So for my personal portfolio, I don't plan on selling out of anything. None of my companies have actually changed the fundamentals of their business yet. If that were to happen, I'm sure I would have to go back and reevaluate that company and that holding. But as of right now, I feel very comfortable with the brands and the stocks I own in my portfolio. So what I plan on doing during this pandemic is buying more. I plan on diversifying a little bit more. I like to contribute a couple new holdings to my portfolio. I currently have 21 individual stocks, and I plan on capping it at around 25. Just to have a little bit of diversity, to not have a lot of my assets into one or two single holdings, I'm going to cap my portfolio at 25 individual holdings for right now with this value of around $62,000. So what I plan on doing is buying into asset classes or sectors of the market that are expected to continue to boom. So these are kind of different aspects of the overall market that are expected to grow even during tough times. And some of these are included such as 5G, digitization, hygiene, home renovation, some autos, and there's a few other sectors of the market that regardless of a stimulus deal, which we now know is not coming, and the fact that we may see a major decline in the overall indices, these are some brands and some overall sectors of the market that are continually going to grow and their products will always be in demand. And I believe those are the brands you want to add in to your portfolio during these times of hardship and the times of worry where the growth from some of the growth stocks that we've seen shoot up as of late may not be there. And these are the companies I'm trying to jump into with some solid valuations. I'm not trying to buy anything with a crazy high valuation at this kind of price point in this volatile market, especially when there's a potential for a further decline. And if we see another 10 to 20% decline in the market from where we currently are, that is when I'm going to jump in and buy those, I'm going to say, higher growth stocks, those higher companies with smaller yields that have seen a massive run up of 1 to 200% as of late. Once those stocks see a massive decline, and those are the companies where the valuations will get a little bit more realistic, those are the brands I might add later on. But what I'm going to show you now are 5 different companies I plan on adding to my portfolio. They're all on my watch list. A few of them are new additions, and others are existing holdings I plan to add to over the next few weeks. And if we see more red in the market, I will be buying as aggressively as I can. And these are going to be some great deals from some solid names that I don't believe are going anywhere anytime soon. And the first stock on the list and on my watch list today is Qualcomm. So this company is up 46% over the past 12 months, and they're trading at $121 a share. So this company operates within the 5G world, and that technology and the 5G expansion has only just begun, and I believe this is a household brand in that name and in that sector that I believe will continue to grow over a longer period of time. They have a market cap of $137 billion and are trading close to their 52-week high, but have seen a slight pullback as of late. If we take a close look at the chart, although shares are up over 2% this month, you can see they peaked at around $130 a share, but I've seen a pullback over the past few weeks. If we take a look at the dividend, currently yielding 2.14%, they pay out around 66% of their earnings in the form of a dividend, and they have a nice 5-year dividend growth rate average of over 9%. So the company is doing a nice job of growing that dividend each and every year by a very fast rate of 9%. And if we take a look, they have a dividend safety score of 80, which is considered safe. So once again, a company where I'm not worried about a dividend cut coming anytime soon. The second stock I plan on adding to my portfolio is Microsoft. I already own this company. It's my second largest holding, but I love their fundamentals. They're one of the strongest businesses in the world, and I have a very strong love for Microsoft. They are up over 40% this year, and their cloud business has been booming. The company has seen great growth over the past 5 years as well, and shares are up over 275%. Trading at a $1.53 trillion market cap, this company might be at a great price point right now because they've seen a nice pullback. 52-week high of $232 a share, a pullback towards the middle of the 52-week range, and yesterday they declined by close to 5%. So this is a brand and a company with such strong fundamentals that they will be operational for a very long period of time. They just reported their latest earnings and beat by both earnings per share by 27 cents, and they had a revenue surprise of $1.37 billion. So this company has posted a very strong quarter. Their cloud platform grew by over 47% year over year. So cloud is the future of technology. It has been growing at a massive rate, and Microsoft's cloud business has been keeping up with the standard and actually exponentially beating how the overall cloud sector has been performing. So Microsoft, I believe, is too strong. One of these companies that I believe is going to continue to operate for a long period of time. I believe they're going to continue to outpace the overall market and provide better returns in the total market moving forward. And this is my second largest holding that I plan to add to during this dip. They currently yield 1.11%, pay out only a third of their net income as a dividend, and have been growing that dividend at a rate of over 10% per year over the past 5 years, with a 99 dividend safety score. And last year they grew their dividend at a rate of 11%. So the third stock I plan on adding this week is Procter Gamble. So I actually recently added more to PG. Last week I bought more of this company, and I have the urge to even add more to my existing position. So Procter & Gamble is so well diversified, they actually generate revenue from 10 different big business segments in the consumer brands market, such as healthcare, baby care, oral care, and many more. And all of their products will continue to grow in demand, regardless of what's going on in the economy. Regardless of the pandemic, regardless on a good or bad economy, they sell necessities. And those are the boring companies I love to hold in my portfolio. Of course, it's great to hold the flashy tech stocks, the stocks that have the potential to go up 10x in a matter of a few years, but it's also nice to have some stability. I sleep well at night knowing I have my hard-earned money into Procter & Gamble. The company pays a nice dividend of 2.3%. They are a dividend king. They've been paying this dividend for over 50 consecutive years and growing it each and every year. Their current streak sits at 64 consecutive years of dividend growth, and they still only pay out 56% of their earnings as a form of a dividend. So this is a company where I'm really not worried about a dividend cut coming soon at all, especially because they have the highest dividend safety score. So like I've preached before on this channel, and I'm very consistent. I share my personal perspective. I have my own dividend investing portfolio and my own dividend investing strategies. They don't align with everyone's point of view. Other people believe the fact that I'm younger and I have a long time to invest, that I should be in primarily high growth stocks. But I believe that, but I also have my own perspective. I own a lot of low yield, high growth stocks, such as Microsoft, such as Apple. I own Visa, MasterCard. I own companies like Costco, which are a retailer, but they have a lower yield and primarily provide more share price growth. Similar, I own Home Depot and Lowe's, and those are some companies that have lower yields but higher growth rates over the long term. So I diversify myself very well, but I do like to hold some boring companies such as Procter & Gamble just for that stability over the long term. Another consumer brand that I do not currently own that I might have to buy into my portfolio if they continue to decline is Clorox. So of course with the pandemic, I believe cleanliness standards and the standards for sanitary needs and the overall cleanliness of the world and of businesses is only going to continue to grow. I don't believe this new trend of everything being cleaned every hour, every 2 hours is ever going away. I believe these are going to be new standards that are going to be set, that are going to have to be met by every business across the globe. And I think Clorox, the name, the brand leadership in that sector, will allow the company to perform very nicely over the next decade. They have a market cap of only $26 billion. They are a dividend-paying company, and as of late, you can see a pullback away from their 52-week high, which sits at $239, and you can see a little bit of a decline over the past few months. So this company does have a dividend as well, yielding 2.12%. Again, they only pay out 58% of their dividend in the form of a dividend from net income. It's only a 58% payout ratio, and they have a 5-year dividend growth rate of over 6.86%, and they've been growing their dividend for 43 consecutive years. So another company that has proven to weather a lot of economic storms, they've proven to grow their dividend through recessions and depressions, and this may be a new addition to my existing dividend portfolio. Their dividend safety score comes in at 75, so not the highest, but is still considered safe, so I'm not too concerned about the dividend payment over the short term. And one thing I really like is the fact that this is a very low beta. I like throwing in some companies in my portfolio with very low betas because it just overall helps to balance out the volatility. I own some shares like Microsoft who dropped over 5% yesterday. So one of my largest holdings dropping over 5% has a large impact on my portfolio as a whole. So I like getting in some companies with a low beta to kind of balance things out, kind of reduce the volatility on the day-to-day basis that will still provide me with a nice return and a nice dividend yield that grows for long term. The final stock I plan on adding to my existing position is Home Depot. Currently trading at $269 a share, they are up over 13% this year as well. And I believe Home Depot and Lowe's, I own both of them in my portfolio, are the retailers that are not going to be affected by the digital trend. They both have some solid online digital ordering platforms already, and I believe these two companies and the home improvement space is not going to go fully digital. I really don't believe we're going to get to a point where people are going to want to buy, where contractors or home improvement, like contractors, people do the DIY projects at home, are ever going to want to buy all their goods online. There's something different about going into Home Depot, going into Lowe's to pick out what you need for your house, and the fact that you can see all the different options in person right there and you can purchase it right at the moment you need it. You don't have to wait for shipping, you don't have to wait for anything like that. I believe these are the fundamentals of these two strong businesses that is going to keep them alive and keep them continuing to grow over a very long period of time. So they are only up 13% this year, and they currently yield 2.22%. But over the past 5 years, share price has grown by 117%. So this is a company where the yield's kind of lower, only a 2% dividend yield, but I've seen more share price growth over the past 5 years, which is what really is driving the total return for this stock. So the yield at 2.2%, they pay out around 52% of their earnings in the form of a dividend and have a massive dividend growth rate of over 23% averaged over the past 5 years, which is absolutely incredible. And they have a very safe dividend safety score at 87, so another company where I'm not worried about a dividend cut coming soon whatsoever. So those were 5 different stocks I plan on adding to my portfolio. I have them on my watch list. There's a few different stocks I don't own just yet and may be a new addition to my portfolio. And then of course I talked about a few different holdings such as Procter Gamble and Home Depot that I actually already own in my portfolio and I might be adding to that existing position. So this week has been crazy. We've seen the stock market decline. We've seen the S&P drop over 7%. We saw the Dow drop over 8%, and we are entering into that correction territory. What happens moving forward, we will keep you updated. I always post videos every single day on this channel, so please hit that like button and subscribe, and I will see you in tomorrow's video.